Hey, everybody, welcome to the Real Estate Podcast. I'm Jon, and we have, as always, Lauren.
Hey, guys.
We got a good one for you today. We're going to do the top 11 tips to buying a home and what to do to get you there. But first, title screen. Welcome to the Road to Real Estate Podcast, where Jon and Lauren help you grow your real estate business. Enjoy the show. Anyways, do we have a giveaway, Lauren? Are we still doing a giveaway?
We
got
do. This
1
is
week.
our last episode before our giveaway. Yes, this is our we're giving away our Roadie 24 Yeti Cooler. Are you summer ready yet? Make sure to fill out the form in the link below, and you can be entered to win. No purchase necessary, and we will draw our winner in the next week.
Yeah, what's the date on that? I don't remember. Is it the 9th?
I think it's the 9th. Yep.
Ooh, look at that. Sometimes this old brain works. Just so you guys know, I have cheat sheets everywhere, taped all over down here. I don't remember what we're talking about, and I just constantly look down.
Jonathan, the only thing I can remember is number 10. You need to pay attention to number 10 because it is the biggest secret in buying a house that you do not know that you need to know.
So that means don't stay to 11. Just turn it off after 10?
Yep, turn it off.
All right, so our first one we're going to do is like the very, very beginning stages. When you're starting to think about buying a home, you kind of have to know where you stand financially. It's a big deal. Credit score. People preach about credit scores from the beginning of the second you turn 18 to buying a car, buying a home. It's extremely important. Your debt to income ratio is important. In the world of mortgages, where we stand right at this time, we're like to be about 45% in terms of debt to income ratio. But knowing your credit score is really important. What's the first step you would do, Lauren?
Yeah, I think knowing your credit score and strengthening the credit score, trying to make it better is really, really important. When you think about so we're going through the top 11 things that we're doing to buy a house. And so this is number 1. Just know your credit score. Most of your credit cards will let you log in and get them. I don't know that I would sign up for a service specifically unless you don't have a way to get your credit score. For me, I get it through one of my credit cards. It's really easy. It's included, so it doesn't have to get pulled all the time. You can also go directly to the reporting. We have Experian and TransUnion. You can log in directly there, and once a year you can get a free credit report. So don't pay a lot. Don't go to one of these sites where you're having to join and pay a lot of money. Typically, you can find your credit score somewhere much easier. The other thing is that when you start talking to a lender, they're going to pull your credit score. So you kind of have an idea of it. You don't necessarily need to pay for, one of these companies to pull it. Just find it within your credit cards or do your 1-year free pull that you can do and see how you can just make it better. The best ways are if there's any errors on it when you have it pulled, you can dispute those. Tell people if something's wrong, if something's incorrect or been pulled funny, you can try to dispute those. Paying down your debt. The lower that you have revolving credit cards, the better your credit score gets. If you carry a balance month over month over month, it eats away at your credit score. Now, with cars and that kind of thing, that is not revolving debt. Revolving debt is like credit card debt or store card debt. There's some debt that's good for your credit. Having a mortgage is good for your credit. Even paying a car on time, good for your credit. And you probably, during this time period, do not want to open any new credit accounts or line of credit. That's opening any new inquiries. And that could be something as simple as financing your couch. Anytime you finance something, there's going to be a credit pull. So be really careful with that.
Yeah. I believe the score that they want you to have for getting a home loan is a 620 or higher.
Yeah, you can get a loan for a little bit lower depending on which mortgage company you go with. Different mortgage companies are going to have a different, they call it overlays, that you put above what is the minimum that Freddie and Fannie, who are the secondary market of mortgages, that's the back end of the mortgage. So in the 600 is definitely where you want to be. You'll have to get a higher interest rate if you have a lower credit score. Mm-hmm. So you definitely want to keep it 620 or above to get a better interest rate.
Yeah. So it's a good idea to start looking at your credit history and everything else well before you're in the buying part, because you can move your score pretty substantially within a short amount of time by calling creditors where they have blemishes. If you've done a one-time mispayment on a credit card or mistakes are made or something gets processed a little late. And so by calling some of those creditors as you go through and get prepared and ask, hey, listen, I missed that payment 2 years ago. Is there any way we can get that taken off my record? And they can go in and get that taken off your record for you. And you'd be amazed at how quickly your score goes up by removing some of those blemishes in your past. But having a good knowledge of what's on there, even those apps that we don't recommend, we'll do a free one. They do a 7-day free trial or whatever, a 1-month free trial. You can get in, print your credit report, and then cancel your account. So that way, at least you know what's on there, and you're not surprised when you go to get pre-qualified or something, and they go, "Oh, by the way, you're a 420." Like, oh, uh-oh.
Yeah, 400, they're not getting a mortgage. And the other thing that I will say when we're talking about like strengthening your credit score, dispute any errors, these are all things that you can do. These are not things that you need to get a company to do for you. There are some companies that my lenders have, and if I go through a lender, then I trust that credit repair company. But if I go to the internet and Google credit repair
It's a bad
companies,
idea.
it is a bad idea. A lot of those are predatory. They will charge you money up front, and they may or may not change your credit score. So just be aware that not everyone is here to help you when it comes to your credit score. So work with somebody that you trust ahead of time.
And this was closely related because we're going through and we're looking at our history and we're trying to get our finances in order to buy a home. We should build a realistic budget about what we could actually afford by looking at what our daily expenses are, what our cost of living is, and then calculating. Like right now, you might be in an apartment or home and your rent is a certain amount a month, and you know how you live day to day, but what's going to happen is at some point you're going to get pre-qualified, and we'll get to that. That's several steps from now. And they're going to say, hey, you can afford a $600,000 home. Just because you can afford it doesn't mean it's comfortable. You don't want to buy something out of your budget just because someone says you can purchase it. Doesn't mean you should. So let's be realistic about what we can afford on our home.
Yeah, that's great. That's number 2 in our top 11 things list, right?
Yeah.
It's really important. I mean, I feel like that the Great Recession of 2008 was based on the fact that people had bought too much house. They were qualified for way more than they could afford, and they just kind of went for it. And a lot of people got caught in a bad place because of that, and they could no longer afford their mortgage. So definitely know what you're comfortable with. The other thing I'll tell you is I do have some lenders that explain to the buyers that typically you can pay about 10% more in a mortgage than you can in rent because of the way that your interest is deducted from your taxes at the end of the year.
Mm-hmm.
And because part of the money that you're putting down is going to equity. Now, less so in the front end of your loan, more so at the end. But
Yeah.
there's kind of a little discrepancy there. And so talk to your lender and figure out where you are comfortable, because this is going towards your equity. You can go just a little bit higher than what you go for rent, but you also want to be really smart about it. And including when you get a mortgage, there's something called escrow. And in that escrow account, they pay for your taxes and your home insurance, not necessarily any kind of maintenance or utilities, but your taxes and your insurance are typically paid in what's called an escrow account. So every month, in addition to the mortgage you're paying, you're putting a small portion of the yearly amount into that account, and that is paid out directly by the mortgage company in most cases, unless you have a conventional loan that you choose to not do. But most of the time, the the mortgage company wants your taxes to be paid and your insurance to be covered, because at the end of the day, the mortgage company is also making an investment onto your house. And the 2 ways that you can lose your house are, one, to an insurance problem, a fire or something catastrophic, a tree falls in, something catastrophic. So that's why they want your insurance paid. And then taxes. If you don't pay your taxes, you no longer own your home, period. And so those are 2 things that the mortgage company wants you to pay, because that keeps your home in place. And so they will put those fees into an escrow or like a savings account for you, and you pay a little bit every month, and then they pay it out once a year or twice a year, depending on what your county and insurance needs.
Yeah. And on top of that, when part of your getting yourself financially ready, it's really important to know that, like, if you're used to renting an apartment or something like that, generally you're not paying those maintenance fees out of pocket because it's getting taken care of by the people you're renting from. So small maintenance stuff, it's a good idea to have a budget for something like that as well, just to calculate in, because know that lawn care and all that stuff that you haven't had to have or take care of in your apartment is now something that you take care of. Also, there's things that go wrong. Water heaters die, HVACs need repaired, and so it's good to have enough money when you're doing your calculations to put in like a maintenance group or an emergency fund where, hey, just in case this breaks, we're slowly putting money in this account every month. So you want room to do that, because that account fills up and it's good because emergencies happen. So it's always good to have that little extra in your budget when you're planning for it. It doesn't have to be, I'm putting $500 a month away. It can be a small amount that builds up over time, but you want to definitely keep that in mind, because you are going to have some expenses that didn't exist when you were renting.
Definitely. And those expenses are kind of rolled into what they charge for your rent. But for you guys, it'll need to be separate. A great way to negotiate that with your agent when you're doing a contract is to ask for the seller to provide you with a home warranty, and that can help with a little bit of the cost when you're first strapped after paying your down payment. Because a lot of times, if you're a first-time home buyer, that moment after you've paid that huge amount is kind of that moment where you have the least amount. You haven't built your funds back up.
Yeah. It's nerve-wracking coming into closing when you realize that all your down payment and all that stuff is all adding up. But before we get there, we've got our credit history fixed. We've kind of figured out what we can afford and live comfortably with in terms of housing. Now we take all that information and we take it to a lender. The real estate agent or whatever you choose may have someone that they work with through their brokerage, or someone they've worked with in the past. There's a million financial situations. I don't recommend going on Google and picking the first one on the ads. So let's get pre-qualified versus, let's do that. What's the difference between pre-qualified versus pre-approved for a loan, and what is better for you, Lauren, when you get into that situation?
Yeah, so we're hitting point number 3. So pre-qualified and pre-approved, they may sound like the same thing, and depending on which lender you're going with, sometimes they call it the same thing, and in fact it is not the same thing. So when you get pre-qualified, you're just having a conversation, you're talking to someone, and they say, hey, what is your income for the year? What's your salary? What's your hourly rate? What's your income? And you tell them, and then you're saying, hey, what's your credit score? And you tell them, and they believe what you say, and then they run you through their program, and they say, okay, well, based on the information you gave me, I think I will give you a pre-qual letter or pre-qualification letter for $500,000. However, because they have no proof of the documentation, that is not a full pre-approval, right? So a pre-approval is not only that they ask you the question, but they actually see your pay stub or your tax records. There are some times when what we make on paper and what our lender uses as income do not match, especially if you have a side business, or you are a subcontractor, or you have some kind of contractor business that you are not being paid as an employee. There are times where they use your tax returns if you're self-employed, and those the way you do your taxes makes a difference. And so if you do not tell them up front that you're self-employed, you just say, hey, I make $150,000 a year, and then they run all your stuff, but on your taxes you have only claimed $20,000, so that you have to pay less taxes, then you are in fact not approved for the same amount that you are qualified for. And that happens sometimes, right?
Yeah.
That happens sometimes, and you have to be very realistic about it. And this is why it's important to talk to a lender at step 3, not
Yeah.
11. Because at this point, if you need to go back and fix something, you need to go back and fix it before you found the house of your dreams, before your spouse has found the house of their dreams and is now mad at you because you haven't looked at all the pieces to get it.
And this is a common one where someone will go and they'll use one of those apps, get their credit score, and go, oh my goodness, I'm a 750, and then they go to an actual lender and they give all their information and everything else. And that lender goes, actually, your credit score is a 680, and they're like, but I checked it on, and this has actually happened to me. That's why I'm bringing it up, where I've used those apps and I'm like, man, my score is killing it, da 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 da. And then for whatever reason, when you're doing a mortgage, they're like, actually, when we do your credit, this is the number we show. This is your real number. This is what we go by through the lending institutions. And for whatever reason, there is sometimes a discrepancy. Don't be freaked out by that. I don't know why that is, but there
Yeah,
is.
I do. Because there's three.
Well, I mean, I know there's Equifax, TransUnion, and
The third one,
another.
we never remember.
It's another. It starts with an E. I remember that.
Yeah, I was like, yeah. So there's three different credit unions and or credit bureaus. Depending on who your lender is, they might use a different one. The two that I see used the most are Equifax and TransUnion. 100%, those are the two I see used the most when it comes to lenders. So some of these third-party companies will average the three scores, or they'll only pull from one of those sites. And whichever one is the highest, they'll typically pull that one because you're paying for them and they want you to feel good. But we are not buying a house with feelings and hopes and dreams. We are buying a house with reality.
Yeah, we're buying a house with reality, but there are lots of feelings and hopes and dreams involved.
Yeah, you can have your feelings, but you cannot buy it with feelings.
Yeah, that's right.
And so I think that, short of number 10 and 11 that we're going to get to next that are really, really, really important. I can't wait to get to those. I feel like number 3 is super important because this is where you have your real reality check.
Yeah. Also, at this point, you need to start thinking like, most people are starting to get excited. You're thinking about your house. You're thinking, oh my goodness, I can buy this furniture. It's going to look so good in our new home. Let's buy this. Let's do that. And it's because you're doing so much looking and you're starting to dream. And it's really important. And every realtor on the planet I know I'm too new, so it hasn't happened to me yet, has had it happen to them where they're going into a deal and someone goes, I just bought this new couch for this new house we're getting ready to buy and we're doing like, do not overspend. It's time to start saving every penny. Don't do anything crazy because at this point, people are starting to look at your credit and we're starting to get serious. So don't get too excited. I mean, get excited. It's okay to be excited. We want you to be happy and excited, but keep the wallet closed.
Yeah,
Hide the credit cards.
Jonathan, that's such a great point because one of the things people think about what their down payment is, people think about what they're putting out there, what they can afford, but they don't always realize that the lender is going to require 6 months of payments in reserves after you've paid your down payment. And so if you don't have a little bit of extra in that account, you're not going to get approved. And so it's going to be really important to put that in there.
Yeah. So the more you have,
overspend.
Yeah, it's important. And it's going to get harder and harder as we go through this list because at some point you're going to have a house and it's under contract. And trust us when I tell you, every realtor talks about someone going, oh my goodness, the money's in the bank. They're already approved. They're going to close in the house. They have it and they go buy a car or they go finance an entire furniture set. And that usually ends that transaction, shatters dreams. So although we're not that far yet.
It's really hard. Yeah. Well, and and maybe it's too soon to interject this story, but I actually had the opposite happen once, Jonathan. This is so funny.
Okay.
This is great. So it's about 2 weeks before closing, and my buyer gets into an accident and his truck is totaled. He has one of those really big, fancy trucks. And so I said, okay, do not buy a new car. Whatever you do not buy a new car. And he's like, Lauren, I got to drive something. His car's totaled. And so I said, talk to the lender before you buy anything. Talk to the lender. Because I'm real nervous because that payment was about $1,400, which I don't know where you guys are in car payments, but that's a number that scares me. That's a number that scares me for a car payment, especially as a real estate agent because I don't know where your budget is. And the lender and him talked, and he got this little tiny beater car for cash, and it made his approval 10 times easier because his $1,400 payment went down to whatever the beater car cost.
Zero.
I think he was able to buy it with the insurance check alone. And his approval shot up and it made all the paperwork so much easier. Suddenly his debt to income was different. Everything changed and it was like the best ever. Now we closed on the house. And of course, then he went and bought his truck that he really wanted.
Yeah.
but it really helped out our numbers. And so I have the opposite story. And sometimes that's what you have to do. I have had people sell their cars in order to buy a house because at the end of the day, the priority was the house first. Now, once you have your mortgage, they don't regulate what you're buying. You can always go buy it back. But to get approved, you might have to do some sidestepping or some downgrading on some things in your life to get to this point.
I'm very fortunate because my current buyer, I gave him the speech we just gave on the podcast, like, hey, don't spend anything. You gotta be really careful. We're going through this process. They're watching you, da 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 da. And maybe I gave my speech too good. He called me the other day and he goes, my wife really wants to go to McDonald's, but I won't let her. I took all the credit cards. I took this. I was like, dude, you can go out to dinner every once in a while. It's okay.
And to McDonald's especially.
Yeah, like, it's okay. You can go to McDonald's. He's like, I'm not telling her that. I was like,
Only
okay.
the dollar menu. Only the dollar menu.
I was like, okay, you do what you gotta do, man. That's not my relationship. I'm staying
Yeah.
out. But yeah, I told him, like, yeah,
Yeah.
go ahead, take her out. And he's like, nah, no, we're not
Yeah.
doing that. I was like, okay.
We sometimes give marriage advice, but that is not our expertise. Yeah.
Yeah, so we kind of started touching on this one. We want to go number 4.
Number 4.
It's
Watch out.
understand all upfront costs. This is the big one. These are the down payments we've kind of been mentioning already. Closing costs. This is where people start to get a little scared. This is the most stressful time when you're in a contract, realizing when these numbers start coming from your lender, like, we're going to do this, and you see like $500 for this, $10 for that, $25 for this. They'll send you a cost sheet. Now, granted, we're not at that stage, we're under contract, but understanding that it's coming, getting into the mindset that, hey, you know what, we're going to go under contract. There's going to be some big numbers. And as a real estate agent, I think this is the part where your client is most stressed. It's their honeymoon phase is buying the house, then the loan starts coming, and they start seeing numbers on paper, and it's like, oh my God, this is so much money, and it is.
And it can be so stressful, right? I mean, it can feel huge. It can feel different. I mean, the first time I bought my house, I actually had nightmares, real actual nightmares, like stress dreams going up to the day of our closing. But sometimes information can help you to just have a better handle on it. Things like understanding your actual down payment and your closing cost inspection. When we had the Great Recession in about 2008 to 2012, you think about some of the bad things that came out of that time. But one of the things that we initially hated, but it's coming out to be okay at this point, was the Dodd-Frank Act, which requires lenders to have some consistent documentation among all lenders. So one thing that you can ask for specifically is a loan estimate. Even though you don't have a house yet, a loan estimate will break down all the fees, all the payments, and it is consistent. It is a federally regulated document from the government, the federal government, so that you can see apples to apples. One of the problems when people were looking at trying to figure out who to go with a loan, they didn't understand one documentation looked like this, one documentation looked like that, and it didn't make sense. And so a loan estimate streamlines the process and creates a more consistent way to view. Now, some loan officers and some mortgage companies are still not going to call things exactly the same, but this does standardize it a little bit so that you can at least compare, apples to apples.
Yeah, what used to happen is you would get a loan thing and go, oh, this one seems way cheaper, and it's because not everything was in it. And now with it being more standardized, it's so much easier to see who's charging more and less, and you can it was uncomparable before. You were completely in the dark as the person that is, I don't know what you call the person that's getting the loan, not the lendee.
And we should say the person that's purchasing the loan. Nobody just gives you a loan. You are purchasing a loan. This is a product that you are buying, and the closing costs are what you are paying for the loan. Your
origination fees and all that stuff are in there.
Yeah, and that's really important because the loan officer is a salesperson. Yes, they are in finance and they know numbers and they're the one that's going to go through the numbers with you, but that person is selling you the loan. They are not going to be underwriting it. They are not on the back end of it. And this is an important differentiation because they are trying to help you. They're not bad people. I'm not trying to villainize them, but they are selling you something. And the same way that you walk onto a car lot knowing you're being sold a car, or to your couch example, you're going into a furniture shop, that person is making commission. So is a loan officer. So, choose wisely. And this is where you lean into your real estate agent to say, hey, have you used this person before? Do they have a good reputation? What's your feel on this? And this is where you lean in and you start creating that group of people that you can trust to help you through this process.
Yeah.
Yeah.
And it's a big deal. And I wish I'd have had those numbers going into my very first home purchase. I had no idea. I went in so blind, and then they started. And it also, like I said, we've talked about in a previous podcast where got to the point where we started seeing those numbers in front of us, and we were a coin flip away from just going back to renting an apartment because those numbers are a lot bigger than if you're not prepared for it than you expect, because it's like, oh, we're putting 5,000 towards this and 2,000 for that, and it's like it adds up quick. So having a good rundown, and obviously there's all sorts of programs that are going to come up when you're going through this process.
Yeah. So, Jonathan, I'm gonna step back into that for a second. I'm gonna swim into your first home purchase.
No.
If you had, and this is a great example, because you get to this point in the transaction where you're feeling super overwhelmed, even if you've done the numbers ahead of time. How would your life have changed if you chose to rent?
Oh, for the worst.
Yeah.
Really, honestly, it would, because I mean, once we finally got through it and we decided to convert, within a couple of years, we ended up selling that property, and the amount of equity we had because of the property value and everything else made our next purchase 10 times easier. And also, we were in uncharted waters, and it was rough going. But obviously, we did rent once after that because we were living in a place temporarily, but
Not the same thing. You
yeah.
have the equity. And here's the thing. Once you get a mortgage, you have better credit as long as you're paying it on time, because mortgage companies always report to the credit bureaus. And one of the best ways to build your credit is to have a mortgage, which is ironic because you have to have credit to get a mortgage, right?
Mm-hmm.
However, once you get it, your credit goes up if you're paying on a regular basis. On top of that, you're building equity. And so equity plus better credit, you're going to be able to buy more and buy more and buy more. And when you do that, you're changing your life. It is literally a life-changing experience because of the way you're building credit. When you get out of your rental, what equity do you have?
Nothing.
Nothing.
And that was my very beginning before I bought my first house. I was paying rent at a friend's house, and he's like, dude, you're paying for my house right now. Da, 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 da. I'm like, okay, yeah, but I can't afford a house. And he was the one that sat down and started going over numbers with me. He's like, here's the deal, man. And he's like, what do you get when you leave my house? And I was like, nothing. But I'd rented a house before I lived with him, and I rented an apartment before that, and an apartment before that. And he's like, well, I'm going to have my entire house paid off. I'm going to get several $100,000. And granted, we're talking back then when I sell this house. Back then, it's much more now. I'm going to get a couple $100,000 when I sell this house. I was like, what? He's like, yeah, I bought for this much. You and Carl pay me rent. You paid off my mortgage. I get everything back. I lose nothing. I'm actually going to get more than I paid. And I was like, what? And he's like, he started doing that for me. And equity, something they don't teach you in high school.
Yeah, it's a game changer. And this is where, when people talk about how do I build my legacy, how do I leave something for my kids, how do I change the story of my life compared to the life that my parents gave me, how do I change the story for my kids or for myself, how do I get to a different income level? The answer is you buy a house.
Yeah.
Real estate's the number one way to, even if you buy something that you're not living in, that you rent out to someone else, they are building the equity for you, like you said. So this is the first step to changing your life. So, okay, I'll get off my soapbox of
No, I'm on it with you. I'm glad we continued forward, and it's paid off every time. We've done very well with a lot of our real estate transactions, which you've been a part of.
Yeah. I mean, it's one of those things that you don't it's not a slam dunk every time. There's no guarantee, but we are not building, there's no more land. There's no, every piece of land is its own unique piece, and people want to live in houses, and so, or whatever.
Is the word when we're studying for license non-homogeneous? It's not. Yeah, it's not homogeneous. It's homogeneous. Yeah, something like that. No, but it's homogeneous. Homogeneous. It's not homogenized. Homogenized is a regular word we use all the time, but it's how everyone is completely unique, and there's nothing can replace the land that you own. They can non-transfer. Yeah. So there's a word for it, and I'm getting it wrong. but I don't need that word anymore, so it doesn't matter.
Yeah, you passed the test. You're done.
Yeah, that's right.
So that was number 4. Number 4 was understand all your upfront costs. There are different loan programs. So we talked about FHA being 3.5%. Conventional can be as little as 2 or 1%. VA has a 0% down payment. I mean, there's lots of options, but just know those upfront costs as far as like your down payment. And then also understand that there are going to be closing costs. There are 2 different types of closing costs. One is the closing costs that your lender charges. Those are loan origination fees. Those are the balances to start the escrow, which are those accounts that pay off your insurance and taxes. And then there's another fees. There are other fees that are like title fees, like to clear the title, if there's any kind of transfer tax that you owe in your county or in your state. And so just know there's different types of fees. There's lender fees and then there's buying fees. And those are something that you can get explained really from your real estate agent and your lender in combination, because you need to know the state and the local laws where you are. And this is just really important because it keeps you on budget, because this needs to be upfront costs that you have to have, at closing. This isn't something you can finance.
And the best way to do that is our number 5. Start a home buying savings account. So as you start to go to this thing, you're starting to get numbers. You're starting to get these like your credit score. You kind of know where you're at financially. You got your loan estimate from a company saying, hey, man, a loan based on this much is average about this much in terms of what they'll put in is their loan origination fee and their percentage for down payment and all that stuff. So now you can start putting an account together. Go, okay, this is kind of how much money I need to buy a house, and just start putting that money in an account that it's not as easy to access. That way you don't go, oh, you know what? Those shoes are nice. It's just a couple $100. I just take a couple hundred. I just get shoes. It's okay. It's all right. Everyone needs Louboutinis. I got to have them,
Yeah, I'll put the money back in. It won't be a big deal. I'll just not let my wife go to McDonald's next week.
There you go. See? Yeah. But yeah, so having a dedicated savings account that's building towards this one goal, I recommend using an account that's a little harder to get access to. Whether you don't get a debit card or something for that account, but you can transfer money into it. Just a little something some kind of inconvenience that stops that spur of the moment purchase. Because for me, if I have access to it and it's easy to get to, I'm like, I could use another guitar. It's not that hard. I mean,
Jonathan has a guitar problem.
It's not a problem.
And a motorcycle problem.
I have good hobbies.
It's okay. Yeah. So guys, while we're finishing up with number 5, if you're not writing these down or if they're feeling overwhelming, do not worry. Jonathan and I actually have a buyer's guide that includes all 11 of these steps for you. If you put in the comments below guide, we can respond and send you the PDF. Absolutely free, no obligation. There's great information no matter where you're buying in the country. So put guide in the comments below and we will send this out to you.
Yeah, it's good to have a little step process to know what you're going through to get into buying your first home, because the first one's a hard one. It gets easier after that.
Much easier with the second home. So that leads us into number 6.
Yeah, because I just said first home. This is the first time home buyers. There's classes and courses you can take. I am a huge fan of it. I ended up taking one through the HUD. No, urban home HUD. And urban development, HUD.
Housing and urban development is HUD. Uh-huh.
Yeah.
Yeah, and sometimes depending on what type of loan you have, or if you're getting a kind of down payment assistance, you are required to take one of those classes, because honestly, those grants and those programs and those organizations, they want you to be a homeowner. They do not want you to default on your loan. They do not want to take your loan back. And so their goal is to educate you so that you are really fully prepared as a homeowner. So just know that there are several different programs that you can do, including one of our workshops, right?
Yeah,
Jonathan and I have a first time home buyers workshop coming up on the 12th of June. And so if you we'll put the link out there for you as well. But check that out. Get the more information you can, because having those programs and knowing what's available to you is a really, really important step. It can help you save. The other thing is that sometimes these down payment assistance programs, they change by county. Mm-hmm. You may be eligible depending on your income, and the income changes on the county as well. We have different programs for teachers. We have programs for police officers. We have firefighter programs. We have lots of programs for people.
And they're worth your time. I haven't taken one in Georgia. I took one before I bought my first home way back in Florida. And this is right after the recession. Things were a lot more complicated in terms of getting your loan. And some of the stuff they did is they had programs that you could sign up for while you were in there. Because while we were in the class, they'd be like, bring us some pay stubs, let's get your credit score. And they would go through your credit history with you and help you clean up your credit history. They would also go through them. Like they had programs where they even had places you could rent from them to build your credit to get to the point where you could buy a home. They also had free Subway while we were there, which is really, really, really nice. But yeah, they just did everything. They went over some home maintenance stuff, things to look for when buying your home. It was very, very educational. It definitely helped a lot. They also had a grant program that if you were under a certain level of income, they would grant that much and you didn't repay it back until you sold the property. So there was a ton of good information there. I actually ended up not qualifying in the end. I made like $1,000 too much.
Jonathan, that happens so often. We have that
Yeah.
story over and over again. But like I said, sometimes it's different per county. And so I had a family that did not qualify for the income requirement for Cobb County. But when we started looking at houses in Fulton County, suddenly they did, because the average income per family was different depending on the county we were in. And then
Yeah.
if we went to Gwinnett, they qualified, and their down payment was double. Just be aware of different types of first-time
Yeah.
homebuyer programs, grants, tax credits, and
Hmm.
know how they get repaid, or if they do need to get repaid.
And all the stuff was good. Like the credit history stuff they did, what we actually talked about as number one. They went through and looked at the blemishes and told you what to do, how to fix it, and all that stuff. Like I said, it was definitely a really eye-opening class because they even went through home inspections with us, you know. So it was definitely something I highly recommend. Even if you've already owned a home, I would go to the class like as a refresher course because some of the stuff they talked about I had like no idea, you know. I'm a big fan of those classes.
Yeah, and I think number seven, or number six and number seven go hand in hand. Number seven is choose the right mortgage type.
And they teach that in the class too. Like they go over the different loans for sure.
And when you're looking at like an FHA or a conventional loan, there are different debt to income ratios. There are different programs if you are a doctor, or if you have a lot of student loans because of whatever profession you've done. They have different programs for you that may forgive or not count your loans in your debt to income ratio. You just need to know the different pieces of it. And then one thing that we're running into today is there's a lot of talk about rate buy downs. And this is really important because some rate buy downs last 1 year, some last 2 years, and then they go up to whatever the prime or whatever the rate is. And you need to understand that is, what that means and what that means to your payment ahead of time. So it's not just all about the lowest interest rate the first year. It's about what are you paying
Over
over.
the life.
The other thing that's really interesting that we don't really have under this category, but when you're looking at mortgage rates, if you want to see a really scary thing, you can look at an amortization schedule, and that is when you look at how much percentage of what you're paying to the company gets paid towards the loan versus towards interest. And that's really interesting because it's important to know that you pay more interest up front and less towards the principal until you get deeper into the loan period. So that's important to keep in mind as well.
A good beginner tip right from paycheck, right from your first payment on your loan, always just a little bit towards the back end. Because when you look at that first loan, it's thousands of dollars in interest and your escrow and everything else. And you get down to how much you're actually paying your loan. It's like $200. So by just doing a principal and adding 100 or 200 to your thing, and make sure you say that you want it to go towards the principal, that's important. You're literally taking an entire month off with $200, you know. And so I always, it's just one of the things that same guy told me how to buy a house. He's like, yo, just a couple $100 a month on the principal, just a little bit on the principal each month adds up so much, and it cuts so much time off the back end of that loan. It'd blow your mind.
Yeah, that's important, Jonathan, because you also lenders have gotten kind of creative about this within the law, but they have different ways that you have to pay things off ahead of time, and so make sure that you know the system that your
Yeah,
particular lender uses. Because we had a lender that until you paid your whole mortgage, you could not pay any of your mortgage, and so it used to be that they say, "Oh, pay your mortgage in two pieces," and you could save interest. But we had a lender, our personal lender on our personal home, that actually would just hold the payment until you made the full payment, and so they wouldn't apply it until the end. Just make sure to talk to your lender to make sure you're getting that benefit, because there was a way we could do it as long as we paid it the full amount, and then, like you said, an additional check, it was fine. But if we just sent it in as one payment, they actually would apply it to the next payment.
yeah, and you're like, well, I
Unless we
don't.
told them. Yeah. So
Yeah,
just make sure that you're, if you're doing the extra, make sure you're getting credit for it. So.
yeah. I did it the wrong way in the first house. I was like, I'll just pay extra. I'll just pay extra. I'll just pay extra. And then all of a sudden it was like, you don't owe a payment for 6 months. I was like, why did the
That was
pay?
not
Yeah,
the point.
I was going the wrong way.
Yeah. So just know that whatever your lender's specific way to do it is, they're going to have a loophole. Find the loophole. Yeah, but that's great. So the Ocho, number 8.
Ooh. Oh, we kind of talked to us a little bit, the maintenance. This one is factoring the maintenance and the moving costs. Moving's not cheap, and it's not getting any cheaper. But I'm also getting older, so I'm willing to pay more and more.
It costs more than a case of beer for your friends nowadays.
It does, yeah. My friends don't show up with trucks anymore.
Yeah, and they don't work for beer anymore.
Yeah, that's for
Espresso
sure.
martinis are way more expensive. You might as well get real movers.
Yeah, like in your 20s, for some reason, everybody's willing to jump in. I think they all learn the hard way that nobody likes moving. And as things get more real, especially if you've already owned a house and you're moving out of a house, I think when you live in an apartment, everybody's willing to help you move. But once you start moving a house, because as your area or your space gets bigger, you get more junk and it's less fun.
Yeah, a lot less fun. So yeah, and while you have that, you can go ahead and interview moving companies if you're going to use a company, and think about it. You don't need to schedule them ahead of time. You obviously have to find the house first, but they do schedule 2, 3, 4 weeks ahead of time. So as soon as you are thinking about moving, get on their calendar. It's easier to change it than to try to schedule it at the last minute. We do say about 1 to 3% of your home's value for repairs annually. This is something that you want to start to save up. It's not perfect. I mean, we don't have an exact number. It may not happen for a while. This is on average. And a newer home, you would expect to be less in the beginning, and an older home, you might expect a little bit more. There is a caveat. If an older home has been completely renovated, then it sometimes resets almost like a new home. But start to think about that, and think about the fact that once you get in there, you're going to want to do some things. So the more money you can just set aside for that maintenance and moving costs, the happier experience is going to be for you.
Yeah, it's important. Obviously, some of the stuff you won't know until you're actually looking at houses, but it's important to take in the age of the AC and the age of different appliances and stuff, because when you buy a home that's got a lot of older equipment, it might last forever. Don't get me wrong, but it's good to plan for the worst and hope for the best. Is that what it is?
Exactly.
But yeah, that stuff, everything is wearable. Stuff wears out, things break. Keeping that in mind and preparing for it financially is a big deal. Because some of a surprise HVAC break is no one's friend. They can get very expensive very fast.
Yeah, Freon is no joke, y'all. They have jacked those prices up, and now it's the eco-friendly. Yeah, it can get expensive. Yeah. And this is the other thing where we talked about a home warranty, right? It may not be the right thing for you all the time, but if you're strapped for cash and if the seller will offer it, it can be give you that little margin if anything major happens.
But just plan for it. Everything here, as this whole list has been, plan accordingly. Start to prepare, and right up into that, we'll just move right on to number 9.
Yeah, because we touched on this one ahead of time too.
Yeah, we've already hit on this on several points.
Yeah. But we're almost to number 10, the one we said.
We're getting close.
The one you may not realize, number 10. Okay, so go ahead. Go for number 10.
Yeah, avoid major financial changes before closing. This is like I said, before closing. So this is letting you know that we're looking at houses at this point. And it gets so hard because you start to dream at this point. We've seen the house and we know our current couch does not fit well in that design of that living room.
What the
So we need
hand-me-down one that
furniture.
you had from college doesn't suddenly fit in your new beautiful home.
Listen, beanbag chairs, it's just not the same vibe when you have.
Blow up furniture. Do you remember blow up furniture?
I had a
Yeah,
blow up
it was a
chair.
thing.
Yeah, heck
It was a
yeah.
thing. Yeah. So no major purchases, no new credit lines. Do not open any new credit. A job change. A job change can mess up your approval, right? If you are changing industries, you have to be 6 months within your industry. So if you
Mhm.
change industries and it's not adjacent to what you were doing, maybe you're in sales and you're still in sales, that may be okay. You talk to your lender to figure it out. But if you were, let's say, like Jonathan, and a pastry chef at one point in your life, and then you jump in and become a financial advisor, those are not adjacent professions, and so you will then have to wait 6 months before you can get approved again because they need you to have some job stability. So keep that
Mhm.
in mind. If it's an industry change, that's could be a delay in what you're doing, or even a loan denial full on, depending on what you're doing. And you don't want to
Mhm.
lose your deposit, depending on how you guys write your contracts in your state, you could lose your deposit. So
Mhm.
be really aware of that. You don't want to find that out at the end. And then protect your cash.
Mhm.
Protect your cash. You're going to need to have those slush funds. Save for a rainy day. We talked about 6 months reserves so that you could prove to the bank that you can pay for 6 months of payments after you've closed. Keep that in mind.
Yeah, it's a big deal.
I think we're at number 10.
This is it. This is the big one. Go for it.
Yeah. Okay. So here's the thing that people don't realize: your taxes. Your taxes are super important. File your taxes. If there's a dispute, if you're on a payment plan, if you haven't decided on the payment plan, this can all affect your taxes. Your payment plan needs to be factored into your loan. And if it is not factored into your loan and they find it at the end, it could crash your whole deal. If you haven't decided on a payment plan, if you're still disputing it, you cannot get a loan until you decide on your payment plan. If you have not filed your taxes, you need to file them. We had a girl one time who was a regular employee. It did not dawn on me that she might have a side gig, and the girl hadn't filed taxes in 2 years because she had a thriving Mary Kay business on the side. So good for
Mm.
her. I'm so proud of her side hustle. That's great. However, it was the most stressful summer. We had to prolong her buying the house until her taxes got filed proactively. And we
Mm.
almost lost the house, y'all. And she would have lost her finance. She would have lost her earnest money. She would have lost everything. She was a single mom, and every penny counted. So luckily,
Mhm.
I begged, borrowed, and did everything I could to keep that listing agent in our deal. And we did it. But we had to wait till her taxes were filed. And it wasn't electronic, y'all. She mailed that in, and it was a problem. It was a problem. So, just so you know, taxes are super important. So, talk to your real estate professional, talk to your loan officer about your taxes, how they're filed, if they're filed, what they do. And if you are a contractor or somehow self employed, your income will be based on your taxes, not what you tell people you make.
Yeah. And you know she's adamant about this because she said y'all with a real
Y'all,
southern.
y'all. I get more southern when I'm more serious.
Yeah, you know it's real, okay? That's how we know.
Hey, we
Yeah.
are in Georgia, y'all.
Yeah. I just thought it was funny. It just really came out for number 10. Guys, I'm
I don't
glad
like
you
to pass it on. So here, guys, you
you
got your
know,
money's worth. Hopefully, it was the price
we've
of
done
admission. Number
so
10.
much financial. I feel like we're missing the main most important thing. I mean, you can't well, I guess you could, but you need to have a good realtor. You have to have a good team on your side. And so number 11, you're looking at it, folks. The best of the best is right here talking to you right
Hey,
now.
hey,
Yeah.
y'all.
She needs to say some y'alls for this one. She's serious. She's good.
I actually am. Jonathan and I both have bad experiences with our first home buys. Ironically, we were only semi-represented, my husband and I, when we bought our first house. And I think, Jonathan, you have some stories about, oh, I wish I'd known this. You had a friend that was guiding you, but
Yeah,
your
yeah.
real
We
estate
ended up switching
professional,
realtors during our
yeah,
first purchase. Yeah.
was not what you were looking for. And so, how do you avoid that? How do you see these speed bumps coming down the road? As a first time home buyer, you probably won't. But that's why
Mm-hmm.
you partner with a real estate professional that will. Now, we have a whole network of people all over the country, all over the world. If you don't have a recommendation, if you don't know who to go to, reach out to us. We can help you find
Yeah, we
somebody.
can find people.
Yeah, we. there's a certain way that agents that do well in their area talk, and there's different networks of people that we talk to all over the country. And so we can help guide you to the right place.
Yeah. And Goldie says hi to everybody.
Yeah, Goldie says hi. She's don't get a bad realtor. That's what she says. Exactly. So, yeah.
She
So I
just
think that's
she
it.
growled because she heard somebody thinking about going somewhere else. That's what that was. She's very territorial.
That was her, y'all. That was her, y'all. Yeah. That's good. No,
Awesome.
That's great. Those are our 11. So hey, remember, if you want our downloadable, just put guide in the comments below, and we can send that over to you. We'll send you a private message, and you can give us your email. That we can. You don't have to put your email in the out for the world. We'll send you a message after you put it there. And
we can also go in more in depth on anything. If you have any more direct questions you have about buying a home, we'd happy to answer those in the comments. And if it's something that's personal, obviously don't put any really confidential information in the comments. Let's not do that. But if you have some tougher questions or more to the point, more specific, we could love to help you with those questions. Just put them down in the comments below.
Yeah. And remember, we have our buyer seminar coming up on June the 12th. So we'll have more information on that for you guys as well.
June 12th, guys.
Yay.
We'll see you guys all on a big Zoom meeting. Remember to like, subscribe, follow, notification bell, and we have the Yeti Cooler. There's going to be a link down below. Usually read the description. Yeah, there's so much to do, guys. You better do all the things.
Yeah.
All right. Have a fantastic one, everybody. We'll see you all next week.
Thanks, guys. Bye.